Howdy everybody, welcome back again to Accounting 1101, where we are all about inventory cost flow assumptions. We've worked through an example where we put FIFO into play, and right now in our video we're going to tackle LIFO, last in, first out. If you remember back to our last video, we talked about the game we're playing. The business is buying inventory, they're putting it on the shelf, and then at that point the inventory can either sell or it can sit. If we sell, it's considered cost of goods sold, and that inventory becomes an expense. If it sits, well, it stays in inventory, and it gets counted in ending inventory. So the game we're playing is a game of allocation. We're buying $100,000 in inventory, and we're allocating it to cost of goods sold for stuff that's sold, and we're allocating it to ending inventory to stuff that just kind of sat and didn't sell, and it's still there. And so we have a couple of different methodologies for that allocation. We can do FIFO, we can do LIFO, we can do weighted average, or we can pick and choose among the three for different types of inventory. Just because a business uses one doesn't mean they can't use the other. They just have to disclose. And so a business is welcome to do FIFO for one category of inventory and LIFO for another category of inventory, as long as they disclose it in the financial statement notes. So that's the idea. And we said in that allocation, if we think about that 100,000, if we're allocating it between cost of goods sold and ending inventory, well, when we add those two together, they should equal 100,000. And when we work through our LIFO example or our FIFO example from last time, we saw, in fact, that was the case. The cost of inventory was allocated exactly between cost of goods sold and ending inventory. We'll see the exact same thing as we work through our LIFO example. Now, LIFO, exactly as you'd think it would be. Last in, first out. We are assuming the last goods in are the first ones sold. Now, again, that is an assumption. We're doing it for accounting purposes, for bookkeeping purposes. In reality, we don't know. We don't know the exact physical flow of the inventory because the individual items are all the same. Now, there are retail places that have the little RFID tags and sensors that they put into packages. And you may have been at Walmart or a retailer before where someone has walked out the door with one of those in their package, maybe inadvertently, and then the thing goes off and everybody looks and like, oh my gosh, what's going on? And so, yeah, maybe we could track individual items if we put an RFID sensor on every single package. That's not cost efficient, not cost effective. It would be way too expensive to put sensors in every single item of inventory. All right, so maybe there will be a day when the technology gets cheap enough where we can do that and we can do more of a specific identification as to what is sold. But for now, we got to use the accounting assumptions. We're using LIFO, FIFO, or weighted average. And again, our example, exact same one from last time. We have the Glass Monopoly board game. We have a beginning inventory. We sold, we bought, we sold some more and bought some more. And so we're going to use all that information and we're going to apply LIFO to try to figure out our cost of goods sold and our ending inventory, just like you're going to have to do in your homework problems. Once again, we have our friendly little Excel spreadsheet here that we're going to help keep track of everything with by plugging it into our Excel spreadsheet. Once again, if you want to write it out on paper and kind of set up the same way, but on paper, that's fine too. So let me pull up my spreadsheet and we will go ahead and we will do a little LIFO. There we go. All set. Got the LIFO template ready to go here. We have our inventory information down here at the bottom. And let's apply a little LIFO. January 1, we have a beginning inventory balance of 1,000 units at a cost of 20. 20,000 in that beginning inventory. Make a line, keep it nice and neat here. January 4th, we sold 700 units of inventory. And so we're going to kind of record that in our cost of goods sold area here. 700 were sold. Now, don't get confused. I mentioned in the FIFO video, you may be tempted to put that $30 sell price in here. That $30 sell price has nothing to do with anything that we're working on right here. We are concerned about tracking cost, not sell prices that we sell it for. Our unit cost is coming from here. We had a layer of 1,000 units. We paid 20 per unit. And so that is where we're pulling that unit cost out of. Now we have 300 left. We had 1,000 to begin with. We sold 700. We have 300 left at 20 bucks. So there we go. Allocating the cost of inventory between cost of goods sold and ending inventory. We had 20,000 in beginning inventory. You notice it's allocated between cost of goods sold and ending inventory. We sold 14,000, we have 6,000 left. Inventory can either sell and leave, or it can sit. January 10th, we bought inventory. We bought 500 units, as you can see right here, at a price of $22.40 per. We end up with 11,200 that we bought right there. So now we have two separate layers of inventory. We have a layer that we began with, and we have a new layer of 500 that we paid $22.40 for. So there we go. Perfect. When you're doing FIFO and LIFO problems, I mentioned before, you need to make sure that you keep your layers in the correct order. Don't move your layers around. And so we began with a layer of 300. My new layer is underneath it. Right on. So now January 22nd rolls around and we end up selling 360 items. We sell 360. Here's where LIFO comes in. We got two layers of inventory. Well, how do we know which layer to pull from? Well, we're doing LIFO. Last ones in, we are assuming, are the first ones out the door for cost purposes. Again, remember, the physical flow could be completely different. Doesn't matter. We're assuming based on the last in, first out methodology here, that these right here are going to be the first ones out the door. Even if in reality, physically, they aren't. So here we go. We sold 360. My new layer has 500 in it. So I can pull all of those out of that 500 with no problem. We're going to assume that we sold 360 at $22.40. So now let's talk about the leftover inventory. I didn't touch any of that beginning layer right there, that 300 units at 20 per. I had 500 in the new layer and I sold 360. So I'm down to, I think, 140 here. Yeah, 140 left. I had 500. I sold 360 using LIFO. I pulled it out of the newest group, last in and first out. And so I have 140 left that I paid $22.40 for. So there we go. January 28th, I want to sell a few more. I sold 240. Now, you'll notice I don't have enough in that layer of 140 to cover 240. So I'm going to have to sell all of that layer and then dig into the older layer. So 140 were sold out of the new layer, which represents basically everything we have there. As Excel brings up a bunch of error messages because I hit the wrong button. So 140 at $22.40. That entire layer is going to go away. Now I got to pull 100 out of that layer. 100 at 20. 2,000. And so now let's talk inventory layers. I liquidated that entire layer right there, meaning it's completely gone. And I got 100 out of that layer. And so the layer of 140 is gone. No more of those. That layer that I had paid $22.40, completely gone. The layer that I had 300 in, I took 100 out of it. So there are 200 left there. All right? So 200 at 20 equals 4,000. All right? And so I got one layer of inventory left for LIFO here. And that's that layer right there. I'm going to go ahead and delete that. I was just kind of showing that for example. Since there's nothing in it, I'm going to go ahead and delete it. I don't want you getting confused. Too late. We're already confused. 600. We bought on January 30. $23.30 per unit. We're talking $13,980. And so my ending inventory is going to be 200 at 20 for a total of 4,000. And then my new layer, 600 at 23.30 for a total of 13,980. So there we go. Looking pretty good here. Now, your problem, you may have a problem or two where you actually have to fill something out like that and put in all the numbers as you go along. But a lot of your problems when you do these type of FIFO, LIFO problems are going to ask you what's our cost of goods sold? What's our total ending inventory at the end? And so that's what we're going to go ahead and calculate here. On cost of goods sold, you can see I've got a number for every transaction where we sold. I'm just going to add those up. And then I've got my ending inventory, which is a layer of 4,000 plus a layer of 13,980. So I've got 27,200 for cost of goods sold. I've got 17,980 for my inventory balance. And again, I told you that we're allocating that total inventory cost that we paid for inventory between cost of goods sold and ending inventory. So let's go ahead and see how we ended up here. The inventory cost. We began with 20. We bought 11,200. We bought 13,980. And add all those up. 20,000. We bought 11,200 and 13,980. 45,180 allocated between cost of goods sold and inventory balance. 45,180. So again, those numbers match up. We're taking that total amount we paid and splitting it up between what was sold and what still remains in inventory. All right, that's it. That's LIFO, how we work through that. Okay, same game we're playing with FIFO. The only difference is as we burn through the layers, we got to pick out the new ones, like we saw in that example right there. So, to wrap up here, LIFO, during inflationary periods, which is pretty much all the time in life, especially for businesses buying inventory, LIFO leads to a higher cost of goods sold because the last products in had a higher cost than older ones. It also leads to a lower ending inventory because the older goods, the lower cost ones, are sitting on the shelf, according to the assumptions here. Now, you look at that and you might think, well, wait a second. Business. I've learned enough to know that the name of the game in business is profits. We want high profits all the time. We want to make a good net profit, or net income, right? So why in the world would a company want a higher cost of goods sold? Because higher cost of goods sold is going to reduce our gross margins. It's going to reduce our net income. It's going to reduce our profits because it's a higher expense. Why would a company do that? Think about that for a second. Why would a company voluntarily adopt an inventory methodology which would cause them to have lower profits? Did you get it? You're using your business brain here. The reason they do that is because lower profits mean lower taxes. And so with a bookkeeping trick, they can lower their taxable income and pay less in taxes. And so that's why LIFO methodology is popular. It's not because it's some super great accounting thing and the best way to account for it. It leads to lower taxes. So companies will adopt LIFO for that purpose. Now, some fun facts about LIFO. To kind of piggyback on our last statement there about taxes and LIFO, we have what we call a LIFO conformity rule. The financial statement authoritative bodies, GAAP, and the IRS have kind of decided that if you adopt LIFO for financial statement purposes, then you have to adopt LIFO for tax purposes. And so we have what we call a LIFO conformity rule. If you adopt it for tax purposes, you have to adopt it for financial statement purposes. All right, you can't have your cake and eat it too. If you're reporting LIFO to avoid paying high tax amounts, then you have to show your financial statements that way. You can't show your financial statements on FIFO and pay taxes with LIFO. All right, there's a conformity rule. Got to do it the same both ways. The other interesting thing about LIFO, international accounting standards, international financial reporting standards do not allow LIFO to be used. If your company headquartered overseas and you're following international standards, you cannot use LIFO. And so sometimes when you read a U.S. financial statement of a company that has retail operations overseas, they may talk about how their overseas operations use FIFO. Well, the reason is because they can't use LIFO, because internationally, LIFO is not allowed. It's a uniquely American thing. All right, so just kind of interesting there. If there's ever a day where U.S. companies decide to adopt that international outlook, there will be some pretty big changes. But I don't see that happening anytime soon because of the tax motivations. That's it for LIFO. If you're working through your LIFO problems and have any issues, please let me know. I'd be happy to help. Send me your spreadsheet, show me your math, and I'll check it out for you and hopefully get you and your LIFO back on track. One more video to go through. We'll talk about weighted average and how to apply that, and then we'll be all done with FIFO and LIFO and inventory cost assumptions. And it's a good times wrapping that up. I hope to see you back here then. Until then, take care, everybody.